Today we're going to explore mortgage terms so that you can better understand the language of lending. You know, every industry has its own vocabulary. The lending industry is no different. Today we will define some specific terms to help you better understand the mortgage process. Let's first work with underwriting. The term underwriting. In the mortgage business, underwriting is the use of a specific set of guidelines to analyze income, assets, collateral, otherwise known as the appraisal, and credit. Conventional loan. You may hear this term, generally speaking, regarding a loan that adheres to a specific set of underwriting guidelines as set forth by Fannie Mae and Freddie Mac. Fannie and Freddie, as they are commonly known, set the standards for underwriting of a conventional loan. Government loans, otherwise known as Ginnie Mae. These types of loans are FHA, VA, and USDA. An FHA loan adheres to underwriting guidelines set up by the Department of Housing and Urban Development, or HUD. A VA loan is specifically set up for our veterans. Generally, VA follows the FHA guidelines with a few more flexibilities. USDA is a government loan set up to encourage housing in our more rural areas and has its own set of underwriting guidelines. Generally, though, it follows closely with FHA. You may hear the term jumbo. Jumbo mortgages are loans that are over conventional loan limits. There are banks, investment banks, and real estate investment trusts that set the underwriting guidelines for these loans. They often will use the Fannie Mae Freddie Mac guidelines, however, and you will find many of their guidelines can be just a little bit tighter. Portfolio loans. These are loans offered by some financial institutions to assist borrowers who maybe don't fit the Fannie Mae Freddie Mac, HUD, or jumbo underwriting criteria. Some other terms we use in the mortgage industry are loan to value, or LTV. This is the percentage of borrowing you are doing. For example, if you're putting 5% down payment on a home and you're financing 95%, you will have a 95% loan to value. DTI, or debt to income ratio. This is a ratio of your income to your debts. For example, if you make $5,000 per month and your monthly debts, including your new housing payment, are $2,000 per month, you would have a 40% debt ratio. 2,000 divided by 5,000 equals 0.4 or 40%. Ability to repay, or ATR. This is a term that's used to describe the process an underwriter will go through to determine if you can afford the home you are looking to purchase. You may have heard the term PMI. Private mortgage insurance is PMI. It's also known as MIP for FHA loans. A VA loan, it's known as a funding fee. It's known as a guarantee fee for a USDA loan, but they're all mortgage insurances. Each of these mortgage insurance programs are designed to encourage us as lenders to offer mortgage loans with very low down payments or high LTVs. Mortgage insurance does not protect you, the borrower. It actually protects us as lender in the event of a default or foreclosure. You may also hear the term combo loans. A combo loan is a combination of a first or primary mortgage with a second mortgage or a home equity line of credit. And we'll employ those either for the purpose of avoiding mortgage insurance on a high loan-to-value loan or when avoiding having to write a jumbo loan. These are some of the key mortgage terms we use. On our next Mortgage 101 series, we're going to look specifically at the 4 key components of a loan approval: income, assets, collateral, and credit. Thanks for watching.